Okay everyone, we are back. We are taking a break from the growth portfolio and selling covered calls and all that jazz and getting back to the basics. Going back to what you guys originally subscribed for, we're going back to our dividend growth portfolio. And today we are showing Coca-Cola stock going down in my portfolio. KO is getting KO'd. And then Lockheed Martin LMT stock is boosting up in my portfolio. And I'm going to go over all the reasons why in this video, so stay tuned. We're going to go over all the main bullet points for Lockheed Martin, like their awesome backlog order, their balance sheet, their earnings per share, their low payout ratio, dividend yield, the same things for Coca-Cola with their balance sheet, their performance of the company, what it's going to look like moving forward, and why I'm making this decision to move more funds towards Lockheed Martin than to Coca-Cola. Now I think that they are both great companies. I won't be selling any shares of Coca-Cola. I'll just be lowering my target percentage. I'll be showing that on the screen right now. So you can see right here on the screen it shows that Coca-Cola is currently a 4% weighting in my portfolio, but that big black bold number, that 3%, that's the target weighting. So what that means is that I won't be selling any of my shares. I'll just be holding what I currently have and just won't be buying any Coca-Cola for a while. But before we jump into all that, if you haven't got signed up with M1 Finance, we've signed up 115 people so far, and $50 is the referral bonus for getting signed up with M1 Finance. So that is 5 times higher than the normal amount of $10. So go ahead and get signed up with that if you haven't already, and that is all down below in the description. Now let's go ahead and jump into the first piece of news that I want to show here, and this shows that Coca-Cola just reported earnings the other day. And this shows that they're finally having revenue come back in a major way. Now, I know that a lot of people have talked about restaurants for Coca-Cola have really been a lagging sector because a lot of the restaurants that Coca-Cola previously received revenue and profit from are no more. Many of those smaller restaurants have closed down. Many of the ones that are opening back up are at limited capacity, and Coca-Cola is just not getting the revenue from those people that they used to. Now, the good news is that is coming back in a big way. And Coca-Cola is now seeing revenue and profitability coming back in ways that we're seeing pre-pandemic levels back in 2019. Now this article on CNBC shows all this. It goes over some of the basic bullet points and details, and I want to go over why I was buying Coca-Cola so hard in 2020. And I even mentioned, I believe it was around actually the same time last year, around July, August maybe, around the time when I was boosting up Coca-Cola in my portfolio, and now I'm actually taking it back down. Looking at Coca-Cola stock price from last year, around the summertime of last year, July, August, it usually traded around $46, $47, $48 a share, right around the high 40s. And today, add another $10 to that. Today it trades in the high 50s, $56, $57, $58 a share. So it's not the same type of pricing that we're used to seeing. And for a company that produces about $2 worth of earnings per share, that is about 10 basis points higher for the forward PE of this company. And we'll talk a little bit more about forward PEs in just a second. Now we're going to start going through some rapid bullet points, some quick qualitative numbers back to back to back. If you don't understand any of these terms, if you're brand new to dividend investing, dividend growth investing, or just my YouTube channel in general, go ahead and look up some of these terms if you don't understand. But first off in my portfolio, Lockheed Martin is going from 6% up to 7% in my portfolio. Coca-Cola is going from 4% down to 3%. Now the next thing I want to talk about is the dividend yield of both of these companies. Now don't worry, I'm going to be reading these off my phone. I'm still paying attention to you guys. I'm not scrolling through TikTok or something. Don't worry, I'm going to be reading numbers off this phone. But first off, we have Lockheed Martin's dividend yield, which is 2.74%. And Coca-Cola's dividend yield is a little bit higher at 2.98%. Now here's what's so important, is that Coca-Cola's dividend growth is much slower than Lockheed Martin's in the past. And I believe that this is going to continue in the future, and we're going to look at payout ratio in here in just a second. But I think going forward, Coca-Cola will probably be raising that dividend over the next 5 years at an average rate of probably something like 3 to 5% if I were to guess, maybe 6% if we were really being generous. Now Lockheed Martin on the other hand is probably going to have a dividend growth rate of probably something like maybe on average somewhere between 8 to 12%, probably around that 10% mark to be on average. And I think even on the conservative side, even an 8, 9%, I think it's pretty conservative for Lockheed Martin. Now, not only is the dividend yield pretty close to Coca-Cola, which is why I'm boosting up Lockheed Martin, but the valuation is much cheaper as well. Now, first off, the 2021 earnings per share for Lockheed Martin is $26.68. That goes up to $27.89 in 2022. And then next we have the Coca-Cola's 2021 earnings per share at $2.18. 2022 numbers go up to $2.36. And if you look at the PE ratio for both of these, that makes Lockheed Martin's PE ratio for 2022 be 13.6 and Coca-Cola's be 23.9. So you can see the valuation differences between these two. Coca-Cola and Lockheed Martin trade at completely different valuations. And the thing is, it's so funny because they're so defensive in their own way. I think a lot of the reason why people invest in Coca-Cola is that it has a very cult-like following, and I would be in that group. I am intending on investing in Coca-Cola for life. There's almost nothing that would make me sell a stock. But that said, you almost lose out on some of that upwards momentum because you do have to pay a premium for that stock. Especially even right now, it's in a bit of a turnaround play. It's a bit surprising to see a forward PE ratio of 23.9. Now on the other hand, that's what's so interesting and so strange about Lockheed Martin, is that it currently trades at a forward PE ratio of 13.6 for next year's earnings. That is so much lower than the average of the market, and I've never understood why this company trades at such a discount compared to its peers. It honestly makes no sense. Okay, but now we've looked at the dividend yield, we've looked at the PE ratios. The dividend yield is pretty close for both of these. The PE ratio is much lower for Lockheed Martin, but what about the payout ratio? Well, if we look at the 2021 payout ratio based off the projected earnings for this year, you can see that the 2021 payout ratio is about 39%, okay, based off of the dividend that they're paying right now. If you look at the 2022 payout ratio for Lockheed Martin, it's about 37%, okay? So right now, not basing any future raises over the next year or two, they're paying a payout ratio that is under 40%. That is extremely low. That is so low, and that means they could so easily continue to afford this dividend. They could literally double it tomorrow and still pay that dividend just fine. Now Coca-Cola, on the other hand, currently pays a 77% payout ratio based on 2021 estimates, and the payout ratio is based off of, once again, the dividend that they're paying right now, assuming no raises in the future. And then 2022 payout ratio is 71%. So you see all the varying differences here. Coca-Cola has a much higher PE ratio, a much higher payout ratio, which is not good, and then they also have a pretty similar dividend yield, just that much higher. But Lockheed Martin, on the other hand, has a dividend yield that's almost the exact same, a much lower PE ratio, and it also has a payout ratio that's almost half of that of Coca-Cola's. And so those are just some of the main bullet points, some of the quick things I want you to look at. Now really quickly, I don't want to really go over so much with Coca-Cola because I know you all know it, you all love it, you've all used their products. They're a soft drink company, they're a beverage company, you all know what they do, I don't need to describe it to you. Lockheed Martin, however, is not as well known. Now, I'm showing this picture of Coca-Cola to show us how diversified they are. They have so many brands, you know it. They're defensive. They're a company that's likely going to outlive me because they've been around for, I don't know, I think it's 47.5 million years, if I'm not mistaken. But Lockheed Martin, we're going to show some of the main bullet points for them on the computer right now. First off, I want to show you this on the screen. You see this little line that I'm highlighting with my mouse right now? It says on their quarterly report, so this was April 20th, I believe, of this year, so this was just a couple months ago, a maintained backlog order of 147 billion. I'm going to repeat that. A backlog order of $147 billion. That is their backlog order. That's how much money they have waiting to receive from them, okay? They are currently expected to receive about 70 billion in revenue, but have a backlog that is over double that size. They could not get any new contracts signed for the next 2 years, and they would still grow revenue year over year. That is absolutely crazy to think about, okay? And not only that, but Lockheed Martin, in the same way that we were talking about Coca-Cola as different brands, now Lockheed Martin doesn't have a whole lot of different brands, and it's not a company that's very brand facing, as it's obviously just mostly sells to the government and specifically the Air Force, but they have a lot of different products. Now I'm going to be talking for a second, and you can see on the screen, it is scrolling through the dozens and dozens and dozens of different products that this company sells. It is seemingly endless, from tanks to missiles to fighter jets to different types of intelligence systems. And even going forward with that, I think what's really cool about this is not what this company already produces. I think what's really interesting is what this company is going to be doing over the next 5 and 10 years. This is the company that's basically forced to innovate since they provide military weaponry, okay? So the government is basically funding this company's innovation, and there's nothing that I could really see that could stop that. Let's go over to their innovation tab and talk about what they're going to be doing moving forward. And they break it down into 3 main categories. The 3 main things that they break it down to is hypersonics, automated systems, and directed energy. Now, I think it's really funny because they use the words directed energy. And that's the professional and cool way of saying lasers. That's just gonna have to be my investing advice from now on. Someone walks up and they're like, Jordan, why do you invest in Lockheed Martin? And I'm like, lasers. But no, it's really cool. I'll pull up some footage here so you can see a little demo, a demonstration, but they are working on lasers as well as autonomous systems. They do have AI features that they're working on for not only military weaponry, but really just AI systems in general. And then of course, they're also working on hypersonics. It's really kind of out of my ballpark of knowledge. I don't really understand 100% how it works, but basically it would allow people to travel much faster. Look into it, it's really cool. But those are all really cool for Lockheed Martin, and I want to show here the history of the company. This shows the last couple of years of revenue growth and profitability growth, and you can see some of these numbers are absolutely incredible. Net sales for the company from 2016 to 2020 went from 47 billion up to 65 billion, and then earnings per share once again grew heavily as well, which is the fancy way of saying profitability. Grew from $12.23 up to $24.60, a little over a double up. So this company has a track record over the last several years and goes way further than back if you want to. I even went all the way back to 2008 and 2009. This company actually managed to grow profitability even during the Great Recession. And that's what's so great about this company, is that it's not really all that connected to the basic economy like a Coca-Cola, or really almost all other companies are. Because they get almost all their revenue from one customer, the government, they don't really have to worry about what's happening with COVID or really any economic cycle out there. They're pretty much gonna go to the beat of their own drum. So that's why I bought more of Lockheed Martin stock. It's a company that I fully believe in. It's one of the largest positions in my portfolio now. I believe it's the 4th largest position now. It's a pretty big dividend payer. It's a great dividend grower, and I think has lots of opportunity for share price appreciation. Thank you guys so much for watching. Go ahead and get signed up with them on finance once again if you haven't already. But thank you guys so much for watching, and I'll catch you guys next time.